Happy Friday, Brian Manning here with your weekly update. Let's get right to it. As you see, I'm back in the office, so working away. And sorry, no more exciting videos for a little while. It's going to be just me at the desk. Let's see. So this week, rates have been worsening. Actually, from January 5th through today, rates have really been worsening. Why is this happening? What's going on? So we talked about this last year. The Federal Reserve has a giant balance sheet with mortgage-backed securities and U.S. Treasuries, and they're going to unwind this balance sheet. And in October of last year, they started this unwinding process by reducing the amount of mortgage-backed securities they were buying in the amount of $4 billion a month. And they're going to keep increasing this amount, the dollar amount that they're going to decrease their buying power by. So $4 billion they reduced it by in October. Every quarter, they're going to keep decreasing the amount. So January, they just decreased this amount by $8 billion. So as the Federal Reserve continues to buy less U.S. Treasuries and less mortgage-backed securities, as they're doing right now, it reduces the amount of buying that's taking place, and mortgage rates are going to go up. So throughout the year of 2018, we're definitely going to see mortgage rates go up. It's not going to be a straight line. We're going to see, some peaks and valleys in this whole process, a little bit of a seesaw, but the general direction of rates will be an increase because of what the Federal Reserve is doing. Second reason why we're seeing movement in the markets is because today we got the CPI. CPI is the Consumer Price Index. Really, this is what we feel is the best gauge of inflation. The Federal Reserve looks at what's called the PCE. CPI we think is more accurate because the CPI is inclusive of numbers for out-of-pocket medical expenses and housing, and we think that everyone's incurring these costs at some level, so we think it's more accurate. So the headline number really went from 2.2% to 2.1%, so not a big deal there. The core number, though, which strips out volatile food and energy prices, increased from 1.7% to 1.8%. And we've talked about this in the past. Inflation is the enemy of bonds. And when you start to see inflation numbers like we have here, a very small tick up towards the Fed's number, which is really at 2%, bond markets aren't happy with this. And we're seeing, a little bit of a bloodbath in the bond markets this morning, and mortgage rates continue on their path of increasing. So again, 2018, we're just going to see ourselves in a rising rate environment. I'm around all week. It's going to be a long weekend. Markets are closed on Monday for President's Day. If you have any questions, give me a call. I'll still be around and working even though markets are closed on Monday. Call me on my cell phone, text me, whatever works for you is fine with me. Happy Friday. Have a great day. I'll talk to you soon.